right, Liam, you ready?
Hey, buddy. Yeah.
Yeah. All right, so Liam, tell us a little bit about yourself, Reinforce Ventures, what brought you to Pittsburgh, what brings you to the VC and startup scene, a little bit brief overview of your background.
Sure. Happy to. So my name's Liam. I'm an investment partner with Reinforce Ventures. We invest in overlooked technologies that will become future trends. And I grew up in Pittsburgh originally, studied economics at Grove City College, did 2 startups, the second of which led me to North Carolina, worked in data science for a while, and then got accepted to Carnegie Mellon, which brought me back to Pittsburgh, started having kids, started having free child care via the grandparents, and quality of life, housing, and everything else stayed put.
What took you to Reinforced, and what do you guys do there?
Sure. So after dropping out of CMU, I was working at Allegheny Health Network, essentially running research using big data. So I was a data scientist doing projects in cancer and whatnot. Within a few months, COVID happened, so I was pulling data for different doctors there. And after about a year of that, being stuck in quarantine and whatnot, started looking to other options. Didn't have a plan, but figured, why don't I take this free time from my commute and see where I can apply it and essentially optimize for funness over a long time horizon, right? So no drug use. And that first iteration was CMU's alumni network, Tepit, was looking for someone to interview alumni who were starting companies. And I was like, well, that's 2 hours a week. Yeah. It's fun. I can do it. So, I volunteered. Within a few weeks, they asked me to help manage the organization. So it was up to 5 hours of funness per week. And then started helping my now business partner do due diligence on deals. I'm up to 10 hours of having fun per week. He offered me carry, so shares in these investments. Every time he makes an investment, I get some of the stocks of that company. So I go to my wife and I say, hey, like 15 hours a week is a lot of time not working, not being with the family, but, I'm getting paid for it. She's like, oh, how much are you getting paid? I'm like, well, it's carry. And she's like, so you're not getting paid? I'm like, no.
The potential of payment.
Potential payment. And, she saw how much happier I was. So she said, okay, was working with him for a while. And then I really felt like I can make that jump from 15 to 40 hours of having fun per week, AKA paying the bills. And reached out to my buddy Scott in North Carolina. I said, hey, Scott, I've been helping this guy with due diligence, spend about 15 hours a week, feel like I have a natural, good fit with this. How do I make money doing this? I know you get paid doing this. And he said, well, I'm not really doing venture capital anymore, but I'm doing private equity due diligence. Our consulting firm will do the technical due diligence for these PE funds. So, you've legal due diligence, you have accounting due diligence. We do the technical part. Why don't you work with us? Sound like fun at the time, paid the bills, right? I'm just like iterating over this pattern again and again recursively. And did that for about a year. We would spend maybe 2 to 3 weeks on a given acquisition deal. So, I did like about 44 deals in a year. It wasn't the full thing, just like a technical assessment. And then the guy I was doing the venture capital stuff with, Ewan Guttridge, we decided to launch a fund together in October 2021, and now I've had more than 40 hours of fun per week ever since. And so what our fund does is we look for these weird overlooked areas. It could be in hardware, it could be in software, it could be in life sciences, but things that are fundamental breakthroughs that we think, wow, this could be really trendy in the future. And we'll back those breakthroughs in the hopes that maybe 3 out of 10 of them become the next big thing. So it's looking for things that are weird and wide, but eventually, your mother or grandmother are going to know about.
And I think that is where the magic is, right? Like, correct me if I'm wrong, but Reinforced's thesis really aligns with kind of the proximity to CMU and Pitt and UPitt and our university ecosystem, as well as just the general types of companies we output in the hard tech space and these very weird deep tech, hard tech kind of companies.
Yeah, the founders tend to bifurcate it into two sources. It's like someone just finishing their PhD, doing a postdoc right there the world's best at naked mRNA delivers some weird thing, electrostatic adhesion, whatever. And the other half tend to be these engineers who are mid-career at a company in Pittsburgh. It could be in Aurora, could be Uber, could be a company outside of Pittsburgh. We don't have really a geographic focus, but there's good stuff here.
It just happenstance.
And so those people are like, well, I've had a boss, I've built this 2 or 3 times over, why don't I just build it myself? And so they leave, and then usually we're first check-in for those companies as well.
Yeah. And for background, I'm with InnovatePGH. It's a nonprofit trying to make it easier for startups to build and scale in Pittsburgh. And our work with Reinforce Ventures includes working with them to support them in their process with Cool Water. Was it Cool Water Capital? What is
Yes.
Yeah, Cool Water Capital. Can you explain a little bit about Cool Water?
Yeah, happy to. And Charles is also a great conversationalist and a fun person to hang out with. So he does more than just helping. But essentially, Cool Water was started by Winter Mead, who wrote the book on venture capital fundraising. And he has a super strong experience in the private equity fund-to-fund space. So essentially, a fund-to-fund is a fund that invests in multiple venture capital firms. That could be either for just returns or for kind of getting a sneak peek to those later stage deals when, if a portfolio company is raising their Series A or Series B, the fund-to-fund can write a meaningful check there when the venture capital firm like ours might be too small to make a meaningful contribution. So that was kind of his background. He started a program called Cool Water, which is essentially like Y Combinator, but rather than for startups, it's for venture capitalists. And each week they go through a different set of materials, whether that's around fundraising, legal, taxation, etc., and help to make sure you cover all your bases and there's not a question you get asked by a fund-to-fund or an endowment or a family office that makes you look like an idiot, right? We needed to pull in sponsors to help us participate in that, one of which was you guys, which we're immensely grateful for. I did learn things, but honestly, the biggest benefit was just the network, the friends and peers I made. It's often an isolated job being a venture capitalist because you have to be contrarian. Every time the market says one thing, you have to say, the market's wrong, we're going to do this other thing, right? And you can either choose to look like, as my brother says, an idiot today or an idiot tomorrow, right? Short term, long term. And so it's good to have peers that you can talk to and say, hey, I'm seeing this in the market. It could be prices, could be fundraising. Are you seeing something similar? Is what I'm seeing anomalous? And or is it normal? Am I crazy or is everyone else crazy? And so having a sanity check with other like-minded people is pretty crucial for mental health and performance in this job. So that was honestly the biggest thing with Cool Water.
Yeah. And on our end, I think it makes sense from a, you want more domestic funds, you want more of that money just continuing to cycle around. There used to be this big conversation in the early 2010s about this idea of like, what comes first, right? Chicken or the egg, the money or the startups, right? Or the founders, right? The investors or the founders. Everyone obviously came to the conclusion that was the founders, right? Like, and then the money will hopefully come. But I think, I don't know. I'd love to hear you if you have any takes on this. But I think I'm getting to the point where I think Pittsburgh startup quality is here, so higher, and then our investor density is probably closer to here, right? There's a gap, and that gap doesn't just magically close. Because I think one insight that you were kind of reaching there was like VCs need to be nonconformist and right, but the reality of the private markets is that VCs are also sheepish, right? Like they also like go towards things and investments that other people are likely to like, both from like a, you want follow-on, you want markups, you want to be able to go to your LPs and look like, hey, like look at what we're doing. It's really cool. Other people like it too. But also from a perceived risk mitigation strategy. So you have any comments on what I was just saying?
Clarification on the contrarian side, and then, happy to respond on, the chicken and egg problem more fully. So, like, I don't. Part of me does enjoy being contrarian, but like, there always is this nagging. Like, I want to go with what other people are doing. Like, to say, like, oh, it's easy. Like, you're going against the crowd. Like, it's easy in the movies, but honestly, like, when it's other people's money on the line, when it's your money on the line, when it's your partner's money on the line, like it's hard. And every single time you have to like, it's like choosing not to do cigarettes. You're like, I'm not going to do that. And it's a really hard, conscientious decision. And for my partner and I, like we have to put like all the structure around it, right? So in our, liturgy as a fund, like we have the C word, and the C word is this holy word that we only admit if we're absolutely ready and we really mean it. Like it's set apart from the rest of the language we use, and that C word is conviction. Yeah. And my partner and I only say we have conviction on a company if we're maniacally certain that this is going to take off. In hindsight, 9 out of 10 probably won't. Yeah. But like in our mind, like we've gone through everything. Yes, there are some linear aspects that could take it to 0, but more importantly, there are nonlinear aspects that could take it 100 or 1,000x. Yeah. Regarding your point on, what's the chicken and what's the egg? I would say it's neither the founders nor the investors, but what a successful ecosystem needs are the corporations. As I mentioned before, half of our deal flow comes through these mid-career engineers who have taken, their code or their hardware or their therapies from dev to test to prod, right? From preclinical through clinical trials. Like they know what it takes to make something that a customer can actually use and benefit from that creates value in the marketplace. And so there's an interesting bifurcation in Pittsburgh that the most mature scene is the robotics scene. And that's where the most corporations have kept talent here. That talent has matured from undergrads and PhD students to competent people who can create value for their customers. And then like, you know what, like I forget the phrase, sharpen my teeth or whatever, but like I'm ready to go and do it on my own. And that's kind of the eigenvector across most ecosystems. Yeah. Boston didn't originally have venture capital funding. It had Novartis. Silicon Valley didn't have, grants. It had the Trader Estate from Fairchild Semiconductors.
Seattle's a good example of this.
Seattle, San Diego, right? Like when you look, okay, what's the common thread? Yeah. It tends to be, large, stable jobs where people can learn how to do something before they do it on someone else's paycheck. And for Pittsburgh, it's very interesting because if you rate the maturity level of the different industries in our startup ecosystem, the areas that tends to be the most mature aren't necessarily the areas with the most funding, although they probably are, but it's the areas that have those companies where people grow and then, they unbundle, they opt out, and they start their own thing.
I guess so. Then the question is, how can we let those people know, right, that this is even like a possible pathway for them as they advance through their careers, right? Like the mid career 28-year-old who's been working in the industry for 6 years at that point, who's like, I'm hitting a little bit of a glass ceiling here. What can I do? So how do we get people? I don't know, like the people from the outer counties even, right? Like working in the energy companies and obviously the robotics and up in the strip and life science companies, et cetera, get everyone involved.
Yeah, I think there's a few things that are helpful. One, having spaces that people can rent that have meaningful durations, right? Some places you get locked in as a tenant for 3 years, 5 years, and it's like, well, I'm either going to be dead by that point or I'm going to be too big for this space, right? So having places that people can work. I think also, making sure like people's non-compete agreements, like allow them to do so, right? Seattle is a great counterexample of that. And then also, I don't know what a good way to phrase this. I mean, we're looking for these people, right? We have engineers say, hey, I'm an LP in Reinforced Ventures, a limited partner, right? I'm an investor in this fund, and I'm reinforcing these portfolio companies, hence the name. Yeah. But I also know this engineer, either at my company or we get beers after work, and like they have this idea they might want to start a company. They haven't even incorporated yet. It's just little picture on a napkin. You and Liam, will you guys talk to them? So that tends to happen pretty frequently. But I don't know if it's about making things easier for people, but maybe it's about making things harder. I've seen more scientists, anecdotally, right? So small sample size, but I've seen more scientists start companies as they become frustrated with the grant system, which tends to be highly mimetic. Everyone gets excited about cancer, then everyone gets excited about viruses, and then everyone gets excited about HIV research, then it shifts to COVID. And it's like by the time you get from your undergrad to your master's to your PhD, you're like, wait, like how do I get like a steady source of grant funding for what I'm passionate about? And then it's like, well, even if I do, like I'm not really going to see it help people because, you know, in the discussion section of my paper, I just say potential applications include, right? And that's when people go out and look for funding. So in some ways, I think it's good to make things harder. But I think the other thing is like having operators who can help with that. Nucleate is one great example of an organization that's done matchmaking, whether it's been people in MBA programs or in pharmacy schools who can be kind of those operators. We also will find, you know, okay, you want to be the CTO of this company. Maybe you don't have that rock star personality to do the sales and the vision, but we know these other people who you can work with, and maybe eventually they become your co-founder. It's not like San Francisco where there's posted wanted sign seasoned CEO on telephone poles. And we just don't have that density. And, you know, I don't see Pittsburgh growing to that level of density, right? Especially it's a cloud native remote working sort of world. But, you know, as far as like a smaller second tier place where it's like I have to be in person for robotics, that robotics can shift from robo plus bio, robo plus auto, robo plus aero. Like it's a kind of can't be beat.
In the venture capital scene, like many other industries, there's been this trend post-COVID of distillation, right? Like oh, we're not going to be so concentrated in two specific areas, thinking about, in this case, like the Bay, New York, and they're still powerhouses in their own right, but like there's more secondary cities popping up, like Austin, Seattle, Chicago, right? Like there's this distillation of investment and attention. Have you seen you guys aren't locally focused, right? You guys invest worldwide. I want to make that clear.
English speaking world, but
but how have you seen your being homed in Pittsburgh, right? Like influencing your diligence and your deal flow, right? Like in quality, quantity, et cetera, et cetera.
Certainly. I think the big secret for us is like there are so many high quality engineers in Pittsburgh and the rest of the Midwest who we can tap into for expertise on deals. We invested in so for instance, one kind of contrarian theme we have is 3D printing specialization. And I promise this is going to answer your question, but a lot of people thought that 3D printers would be generalized. So my grandma breaks her teacup. She needs a new teacup and she's going to 3D print it, right? Just like your computer printer. That's not what happened, right? What happened was, 3D printers are used by technicians, by people with specialized skills, just like a CNC machine, which is a better analogy for a 3D printer than your traditional, paper copier and printer that you use at home or at FedEx. So with that said, like there's this company that is a very specialized type of 3D printer for wire harnesses. So wire harness, there's the small wires that go into your semiconductors, which a lot of people are excited about, but there's also big wires, right? What are the wires that connect the lighting, the locking, and the door mechanism for your car? It's a wire harness, right? The big wires. What are the wires that cause 50% of house fires in the developed world, whether that's the wires behind your refrigerators or in your housing units or whatever? Those are wire harnesses. And so it's kind of the last vestige of manual factory production for consumer hardware goods. And so there's this company in the UK called Q5D, and they're automating that. They're 3D printing these wire harnesses for companies. And so we pulled in one of our investors who 10 years ago, his PhD thesis was around, can you automate wire harness production? His assessment at the time was, we're not quite there yet, but it's like literally the world's best person to assess that business. And so, the talent, I think, in the Midwest, the no BS attitude can't be beat. Do we have the startup density that Boston or San Francisco has? No. Are we going to get there in 10 years? No. I think I view the ecosystem of startups kind of more as cloud native and nebulous. Like
Yeah.
we talked to founders in Pittsburgh and in Norway,
Yeah.
and it's hopping from one Google Meets call
to
to another,
Yeah.
and it's there's no change between the two. It feels like the same thing.
Yeah, that's pretty interesting. And then throughout your evaluation process, right, does let's say you're talking to a founder in Pittsburgh, does being able to grab coffee with them at Starbucks, at Red Hawk or whatever, is that important, right? Like, is that a thing that is important in your diligence process? I know a lot of people are like, oh, I need to meet the founder at least once. We need to have like 5 coffee meetups before I'm like really deciding to invest. Like, this is also a good question for the founders and who might be listening is like, what does your evaluation process look like?
Sure. So at this day and age, everyone can raise funding from anywhere. We've had Pittsburgh companies raise from Tiger Global, from Andreessen Horowitz. Like
Lightspeed.
No one's safe anywhere.
Yeah.
So I view it very much as like I'm not just quote unquote competing frenemies with local Pittsburgh funds, but we're trying to get the best deals around the English speaking world. And with that, I would encourage founders to get on phone calls with people in California. We do try to meet in person when we can. So, we'll fly to different places. I think one benefit I have is my mother was a psychiatric nurse and my father was, a detective and interrogator. So growing up, like dinner table conversations were about analyzing people, body behavior, recognizing contradictions.
That's pretty interesting.
Where were you Friday night? What did you get to eat? Who were you with? What was your alibi? Those sorts of things. Like it's exactly the same thing I do. I'm interrogating startup founders as opposed to criminals. So it's a little harder because everyone's guilty, right? They're all telling you this lie, and you just have to decide which lie you want to believe. I think from a geography standpoint, the hiccup people are going to run into with fundraising is when it comes to later stage fundraising. So in this climate, people tend to have like 2 sets of convertible notes or safe notes that they'll hand out, which is essentially a debt instrument where they're like, okay, like when we issue shares for the company, right, stocks, you'll get those stocks, but this is a debt instrument today at a better price. It's just a couple pages, and we promise in the future that this debt will convert to equity, right? So it could be a convertible note that converts. It could be a safe note, which is what we tend to do. And so that might be one seed round. That might be, and these terms are nebulous and not specific at all. Could be pre-seed and then seed. Could be friends and family, which is actually when we tend to invest. We like to be the first check-in to these companies we invest in. And so you go through these, higher and higher valuations of debt that converts to equity. Eventually, you have this big round called a Series A, where equity is distributed. Sometimes it is in the seed, but usually a Series A could be between like 5 on the small end, 10, 12, sometimes 15 million. Could be higher than that. And I think that's where a lot of these cities like Austin and Pittsburgh that you mentioned run into difficulty because you don't have many Series A, Series B funds around here. And so if a founder in the Midwest or anywhere in the world flies to a New York, a London, or a San Francisco asking for money, it's like, hey, it's nice to meet you, but like, I don't know you, right? And a lot of the founders they do back and that they're trusting, $10 million or $50 million with, like, they've known them for 5 years. They saw them get divorced. They've seen them drunk at parties, right? They've seen them at their worst. And there's just a level of trust there that you can't get. And so what I've recommended to people is like, if you're the CEO of a company that's not in a top tier financial city, like you should be flying to a top tier financial city regularly, whatever that means to you. And you should be building those relationships. So there are benefits to a Pittsburgh or an Austin, but it is not everything for you. And you do need to be networking in New York and San Francisco. And that's not going to change over the next couple of years.
What would you say? I work with a lot of founders that are more in the like earlier than that, right? Like so pre-seed, seed stage, and there's just a plethora of difficulties raising. Obviously in this climate, but even if it were hot, it's just hard to raise generally. Even if you like have like good revenue for your stage in Pittsburgh, what would you say about the concept that, at Series A, at Series B, you have more to underwrite, right? Like you have revenue, you have customers, you have all these like different metrics that it just makes the process a lot more streamlined, automated-ish. Not actually, because you still need those interpersonal relationships, but versus like early stage investing, which is very much, I kind of like the cut of their jib. I kind of like their vibes. There's a science behind it, but like it's an art and a science. And so like those interpersonal relationships, even higher, even more valued at the early stage investing period, because you're really investing in potential of the person. What do you think about that dichotomy, right? Like I know a lot of people talk about, okay, like a lot of these second tier cities, they lack funding once you get to Series B, Series C, even Series A, depending on the city. But I don't know. I feel like maybe it's just from like working with these signs. Like it feels like, like if you're, I don't know, like the next Duolingo, if you're a consumer software company, even, and you're in Pittsburgh, it's like you kind of gotta, maybe if you have some early revenue, it's like, I don't really know many pathways to a successful raise here for that company.
Sure. So in general, the point you touched on with vibes is absolutely spot on. I tell my 7-year-old all the time, vibes are everything. And it's not like the market is hot versus not. There are always things that are hot and there are always things that are not. And so what I recommend is people understand like what current zeitgeist or vibe is the one they fit best into. So things that are exciting right now are large language models and defense tech and batteries, right? And so it's like
climate tech.
Figure out which vibe you fit into. Find a tribe leader in that vibe, local, who has friends that are not local who have that vibe. And just like that's your tribe. Work with that tribe. And so I would recommend fundraising with less VCs, but finding the one that you resonate with, who's going to tell all their friends to go invest with you. Because my friends, I do have friends in Pittsburgh. Like I also have friends in San Francisco and Miami and Austin, New York. And I meet with these people, and literally yesterday and Monday, hey, what deals are you seeing? What deals am I seeing? What can we work on together, right? And so finding one investor locally who's willing to tell his non-local friends what's happening on the greener side of the grass, I think is crucial. Regarding what to do when you don't have revenue or more those late stage metrics, it varies fund by fund, which is why I recommend, like, when you finish a pitch, ask the investor, hey, so what did you think? Because if you don't ask them, which it's such an awkward, painful question, but if you don't ask them, you're never going to know. And if you do ask them and you just sit there with your mouth shut and you let the awkward silence just eat away at them, like, VCs want to feel smart. They want to have an opinion on everything. So they will tell you what they like. They'll tell you what they don't like. And if you ask correctly, you might get like what the finish line is. And to be fair, as a former founder, like, I do try to tell startups when I can see it, hey, we're going to pass, but if this was different, or if you were doing that, like, this is what would give us conviction to invest. And sometimes they're like, that's not the direction we're heading in. Makes sense. Like, it feels fair to me, and I'm going to refer companies to you because you treated me fairly. Or they might say, okay, great. Like, we might actually hit that target or reach that milestone in 3 to 4 months. I'm going to follow up with you then. So when there's not any of those factors, the things that we like personally at Reinforced Ventures are, one, irreplaceable competency. So can the founder prove that they're the world's best at what they do? If they get hit by a bus, we wouldn't be able to find someone with their research expertise, with their network, with their vision to do what they do. Thing number 2, is this a fundamental breakthrough? Have they built a new algorithm or discovered a new class of molecules, or done something that gives them a wide open space that's applicable to multiple, even sometimes unrelated industries? So we're really looking for that breadth of applicability. That's not to say they're not going to commercialize in just one market, right? At the end of the day, you have your one killer use case. But for us to have the imagination that, oh wow, like, this is such a big deal that it could be used for all these things.
Yeah.
That's how we try to quantify like how big of a deal it is by its breadth, even if you're just going for one thing for depth. And then the last thing for us is in overlooked areas. So if something's trendy, if we've heard about it 10 times over, we're just like not interested, right? So irreplaceable competency, fundamental breakthrough, and overlooked area. It's really hard to find companies who have all three of those things. So when people send us deals like that, we're very, very grateful. But if someone checks all those boxes, we're more than 50% of the way to investing, even if they've had very little traction.
Is there any interesting areas that you're either observing or maybe a public investment that you've made recently that's like, oh, this is like really weird and interesting, that you just yap about?
Yeah. Every single one. I love all my children equally, but the one that we've gotten the most feedback on as far as like that is super weird and that could be applicable to everything, and these are the world's best people, would be investment we made in Hexium. They're based in Austin, Texas. I've never met them face to face before, right? This has been all through Google Meets, and what they essentially do is they take lasers and they excite atoms with those lasers, and the atoms that have more neutrons get excited one way, the atoms with less neutrons get excited another way, and so it's a way for them to filter out isotopes. And so with that, you can do stable enrichment for the first use case everyone thinks of is fission and fusion, right? But even if you take those off the table, like low cost domestic isotope production for healthcare imaging, for oncology, right? Like for all these different areas, just like put the nuclear fad aside, like all these dinosaur industries that have to, ship in stuff from Copenhagen that has like a 48-hour half-life. Like it's absurd. And it's like applicable to a wide array of areas. Using lasers to filter atoms just sounds cool. So, that totally checks the box. And the CEO, Charlie, solved a 50-year-old problem in laser confinement, like by himself. Right. So it's like, well, geez, like if Charlie dies, like he's the world's best at what he does. So that's one very weird thing that we've done that we're excited about. Another example from this previous quarter is a company called Acrylic Robotics out of Montreal, and they've invented these new algorithms that allow you to accurately paint using robots. And so at first it sounds a bit like, okay, like an artist can like set up an Etsy account and issue, 50 replicas of their painting that gets the texture just right and the color and all that human detail, and maybe people who are below the poverty line or a bit above the poverty line. Cool, but like, but then you get into like all the partnerships with hotels they put together and with hospitals and with clinics, and it's like, wow, like, I mean, just paintings for cruise ships is $1 billion market. Like, oh my gosh. And then you get into like augmenting human experience where it's like, okay, you're taking generative AI and you're making it analog, right? Like that's kind of weird, And
wide.
So it's augmenting human experience and opening up all these B2B markets. And she just has this amazing personality, like it's like seeing someone who's not a celebrity yet, but could be. So those are two recent examples of people who are doing very weird things, but it's like, wow, this is super broad in its applicability.
How do you think about kind of that time to market and traction question, right? You need to return DPI to your LPs. A lot of the companies you invest in are more hard tech, deep tech style. Like they might have longer time horizons. Like, how do you think about communicating that to your LPs? How do you think about like managing that? Some people I know like might do maybe software in legacy industries as well to complement that and kind of like smoothen out that time horizon. How do you guys think about managing that?
100%. So there's a number of good things, and then there's the ultimate thing. I'll express the good things first. Good things are, there are early exit opportunities for some of the therapeutics in our portfolios, some of the software-only companies. But really, like all that over strategizing aside to belittle it, like our founders have received acquisition offers. Like they regularly do, and they love bragging to me that they didn't accept those offers, right? The $50 to cash out. And it's because these people who are irreplaceably competent, like their ambitions are greater. This is their baby. They're in it for 10 years plus. And so the ultimate thing, the thing that I want our investors to experience, and our founders to experience in a way, which I'll get to in a second, is like I hope you collect these companies and just cherish owning them for its own sake, right? Like, would you sell Amazon stock? Are you like, you know what? Like I had Amazon when Amazon was worth only $8 million, and
So
like
it's a souvenir at this point.
it's a souvenir. Yeah, I'm hoping people like value it, because that's really what I think separates the Warren Buffetts of the world from others. Is it's like, Warren Buffett has no desire to sell. He doesn't get tempted by the market. Warren Buffett, in some ways, isn't actually making money. He's an obsessive collector. And so I'm obsessively collecting baseball cards, and I enjoy just holding them for my own sake. So it's very long term, but I mean, we're trying to, generate companies that are producing 100-fold exits.
That makes sense. And so I guess I probably know the answer then, but have you guys decided on like a, there's a million ways to slice this apple, this pie, or whatever, like whatever the metaphor is. And a lot of VCs are more on the, okay, like I'll sell 20% at, I don't know, like when they reach above a certain valuation threshold, right? Like in whether in the secondaries, IPO markets, et cetera, et cetera, et cetera. Have you guys thought about like a more like a systematic way that you guys are planning on approaching that? That like you'd want to let founders know beforehand, right? Like as like a thing that's like, okay, cool, like this is just how we operate with all companies. In this kind of way.
It's kind of cool. We actually, with the way our back office is set up, we give our individual investors more autonomy and freedom if they so choose. So, for instance, they can increase or decrease their commitments quarter by quarter based on how their public markets portfolio is going. They can choose what companies they double down on, and we'll reduce our fees with those double downs. So like, I've been tracking Hexium or Swan or Acrylic for the past year. I'm excited about their next round. I'm going to put all my money into one of them or the other, right? And that gets more engagement. That gets them to make introductions, whether that's for key talent hires or new customers or for potential advisors. And really getting our investors to do the heavy lifting for us is what makes Yoon and I, more productive, because we're working with a broader team who are reinforcing them. And so part of that is, towards Series B, Series C, individual investors can choose to sell their shares or portions of that on the secondary market. And we respect those decisions and understand that some people either need early liquidity, but the way I see it is like, with the benefits you get from a tax standpoint, like you'd really want to hold in for the long run, right? So I'm not a financial. I'm not a
financial advisor. You got to get the that tagline.
It would be worth people looking into qualified small business stocks, so QSBS, these benefits where if you hold shares for more than 5 years, you don't have to pay capital gains on that from a federal standpoint. And for most states, you don't have to pay on a state standpoint. If companies qualify, right, which I'm not saying they do or don't. But, unlike your 401k or other asset classes, like you can leverage against that equity that you're holding, right? So it's like, I don't know why you would want to sell early, your personal circumstances aside, because you can leverage debt against those assets. You're going to have lower taxes the longer you hold on to them, assuming they qualify for QSBS, right? So from like a tax strand, and you have less tax events, right? If you sell your stocks every 12 to 18 months, you have a tax event every time you sell your stocks. So I think set it and forget it strategy that you can leverage against when you need liquidity is much better, especially in this climate where interest rates are up, demographics are down, so real estate's not looking as good. Post Dodd-Frank, like companies aren't IPOing, they're doing acquisitions, right? So it's like you look at family offices abroad, when they want exposure to the U.S. market, they're not getting the S&P 500, right? They're investing in large private equity firms, and that's what gives them exposure to the United States of America. It's this unfortunate thing where, like, sorry to ramble and get up on my soapbox,
please,
but like, before all these financial regulations after the 2008 crisis, like the average American, the lower middle class widow, she could get exposure to the American dream by investing in the S&P 500 or the Dow Jones, right? And it's like today, if you want the best of what America has, that's behind closed doors for accredited investors. That's in the private markets, because the financial regulations to be listed on a stock exchange are just onerous. And it takes so much time. And they're like, well, I'd rather just get acquired by one of the big, oligarchic
Google, Meta,
exactly,
Amazon.
So it's really this unfortunate thing, and I mean, you see it over and over, like Venice and Genoa, another great example, right? So in Venice, Italy, anyone could take shares in the trading ships that would go out and trade in the Mediterranean more broadly. In Genoa, it was more of an old boys club, and that's kind of like where America's heading, where it's like, if you want exposure to America, you have to be rich enough and you have to have the connections to get into these private market deals. In Venice, like, widows after their husband died would take their dowry and they'd invest it across multiple shipping companies. And it's like, they felt like they had some skin in the game. They felt like they were a part of the Venetian dream, if that's a phrase. And so, I think it's unfortunate that there's less and less of that, but private markets, from a tax standpoint, from an access standpoint, from a regulatory standpoint, seem to be the way to go.
So my last question, I think, is going to be, where do you see Reinforce going long term? Like, what's the vision for the firm? What are you and Ewan thinking about?
Even I have trouble saying that.
You and Ewan thinking about for, I don't know, like what it looks like 10 years now, Fund 3, Fund 4, Fund 5.
Well, we don't, we're very agnostic to what the future is. We're like, we know not what the future is. We just know that it's not what we're doing right now. So, I to be intellectually consistent, if we don't know where the markets are going, if we don't know where technology is going, which I know is, heretical for a venture capitalist to say, maybe we don't know where our fund is going. There are, however, recursive patterns that we hope continue to play out. We want to continue growing our network of investors who reinforce those portfolio companies. We want to continue seeing our founders who interact and build partnerships together. It's been a really cool community that we haven't even had to push. But because what they're doing is so specialized, I got a text this morning, a picture of two founders in Boston. Like, I didn't facilitate that, but they just find each other. And then there's the question of Karl Popper had this idea of falsification theory. So, like, what is the criteria to prove your thesis false, right? And so it's like, well, the Popperian approach to this is like, well, what would need to be true for irreplaceable competency, fundamental breakthroughs, and overlooked areas to not be a winning strategy?
A perfect market.
So efficient market hypothesis, right? That's a really good one I didn't think of. And you could argue we're heading in that direction. I would argue we're not, but you could argue that.
Sure. They've been arguing that for 200 years. that's sure.
The other option would be, maybe these generative AI models and LLMs, take us to this point where being hyper specialized and being the world's best at something actually like isn't the winning advantage. And so maybe there's like this level of generalization and I don't want to say incompetency, but being a a jester, a jack of all trades. Sorry,
Ideas guy.
Yeah,
The idea guy wins.
Like there are ideas guys, ideas girls that we see that we're like, yeah, you're prolific in your thinking, but like you don't execute. And maybe in 10 years with artificial intelligence, those people will execute, and we'll miss that and we'll be wrong, right?
Yeah.
So like that is one potential future where our thesis would be incorrect.
Yeah, that makes sense. All right. Well, I think that was all my questions. Do you have any questions to end us off with? If not, we can just skedaddle.
Great. Thank you much.
Yeah.
Appreciate the time.
Thanks for taking the time. Yeah. Well, see you guys.